Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Bob's back from vacation. We're going to dig into some economic data, and what we're going to find is it's the same old thing over and over again. So we're going to talk about that in this video. Let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, how was the trip?
The trip was awesome. Just in case people are wondering, I had an opportunity to spend 6 days down in Jaco, Costa Rica, with a bunch of friends, and kind of like a surfing, relaxing trip. It lived up to its billings. Awesome place, Phil. It looks like Hawaii, but 100 years earlier in terms of it's much more rural and rustic, and people are great, and weather was perfect. And so, but I'm glad I'm back. You can only relax for so long. And it looks like we had a change in tempo since I left. No surprise for us. The OPEX is over. And I think we have some pretty cool charts here to share with people. I think now that people see market doesn't just go straight up. You know, there's a phrase that always comes to mind in what we're going to share today is basically thank you for your service. And it's kind of a smart ass way of saying that I just put you into something that you don't really want to be part of. And I think people are going to see that in the stock market pretty soon, Phil.
Yeah, I mean, I totally agree. And I think what we're seeing, we say it happens over and over again because it does. You know, we're going to just dive into these charts here. You know, the sentiment indicator, this is from Goldman Sachs, right? This is
amazing.
You know, as crazy high as you'll ever see. And, you know, Bob, I think we were talking prior to the video that this kind of stuff you can get away with when the Fed's accommodating, or, you know, you're coming out of big bear markets. But, you know, when you're at the top of a move and the Fed's not accommodating, this is where, you know, it's the old, let me sell you this big bag of rocks and then pull the rug out from under you while you're falling over the boat.
Yeah. You know, it's funny, Phil. Great analogy from our trip on that is that there's a surf camp down where we were, Playa Hermosa. It's like the most consistent break in Costa Rica. And so one of my friends was asking the guy that runs a school, which they know each other, the guy's from San Clemente, California, said, hey, when's the best time to ride this break? And he said, for sure, low tide. He said, except you have to know where the rocks are. And I think this is the same kind of analogy here, is that, you know, we've really pushed everything to the very best it could be. And now it's time to look at some of the rocks.
Yeah. And then the other chart we have here is the retail sentiment versus the S&P 500. So that previous one was the just overall sentiment, and then this focuses on retail. Again, you know, you're up here in the stratosphere as far as sentiment. And again, this is okay. If you look at this chart, you're going to say, well, it's been higher before, and that's right. And the market did keep going up. Big difference, though, is that the Fed was printing 80 billion basically dollars a month, and it was finding its way into the system. And we're getting the opposite here. So you're overbought from the standpoint of there, you know, this market has to kind of stand on its own 2 feet. There's no Uncle Fed, you know, giving you an allowance anymore. And so when you get to these levels, and you can see it on the chart as we got past 2022, the beginning of 2022, every one of these moves up in retail sentiment, Bob, is basically just putting in a top in the market. You know, I would say based on that, the higher that sentiment reading goes, you know, the larger the drop. And we're up here basically where we were back at the beginning of 2022. And then that saw us go from, what was it, 4,800 or so on the S&P 500 all the way down to 3,500. So, you know, all things being equal here, I think, as we've been saying, the second half of the year is really set up for a fall.
Yeah, and people, you have to understand when we see sentiment readings, people usually are trading with their sentiment. So everybody's in on the pool. We talked about, I think I talked about this, this last week, is that the participation level at the retail rate is almost impossibly high. And also at the institutional level. So you have what I call dumb poor money and dumb rich money that are chasing this market. And the quant guys are telling us the game that's being played is that they're shorting. These guys are no longer net long. They're net short the market, but they're buying calls. So all they have to do is just let basically an expiration just expire, Phil.
Mm-hmm.
And there's nothing holding this market up. So they call it stock replacement, so you got a position here now where these guys are net short and they're protecting themselves with calls, but at some point they're going to say, hey, bombs away, and go walk away from it.
Yeah, exactly. This next chart was very odd to me, and there was some commentary on it out there in the financial world about this is the 6-month change in the NASDAQ 100 trailing PE ratio, right? Price to earnings. Now, you're going to look at that and say, well, it's up at levels where we came out of bear markets, and you would be right. And that's basically what happens, right? You come out of a bear market, you're going to get, and both of those previous high prints, the Fed came in to save the day, right? You had the great financial crisis, and then you had COVID, and now we're getting this print. However, the Fed isn't here to save the day because we're at cycle highs. So what that's telling you is that you're not coming out of what these prints do is they surge out of a bear market low, and especially when the Fed's accommodating and throwing money at the market, you get this initial surge, and then the PE ratios kind of come back down as the market starts to grind up. Well, you're basically going in at these overbought readings at the top of the cycle. So it's okay to get this when you're at the bottom of a cycle or the bottom of a bear market. Perfectly normal. In fact, it's a great exit for the bear market signal. Not at the top here. And it's dangerous because now you've gotten way over your skis. And not only are you dealing with a PE ratio that has to come back down and mean revert, it's going to happen with a market that's also pricing or is over its skis in terms of price. And so you got double mean reversion. You got mean reversion on PE ratios. You got mean reversion on the stock market, Bob. I thought this was a bizarre chart.
Yeah. So top 10 stocks, 97% of the move. Top 3 stocks is 48% of the move. So it's even crazier than it looks because the breadth is so poor. And when you talk about, remember, price can go down and earnings can go down, guys. So we're definitely looking for a PE contraction here. There's no way with the Fed funds rate over 5% do these PE levels last in the market. And I think we just saw the last hurrah of that. And these last couple of days here, the market is starting to show its true colors.
100%. And then the last chart, which I think is the most stark chart on this, Bob, and I'll let you talk to this, is money supply change year over year. I mean, this is bonkers.
Yeah, and this is the whole world, guys. I mean, really all that matters is that they shot it up and they dumped it. It's funny because they talk about how Federal Reserve steal from people. They say they first create inflation, then they create deflation to capture the assets. Yeah. Well, here it is in monetary flow terms. So we're going to see here over the next couple of years is basically assets going down a whirlpool because there's just there's no way that you can avoid a catastrophe with collapsing money supply. And one thing about it, once this cycle starts, inflation is easier to tame than deflation is to fix. And I think they've unleashed a monster here, Phil. So it's going to be really interesting to see how they try to back out of this when they start seeing the big problems coming. Right. But once deflation takes hold, just ask the Japanese. It took them 20 years for them to get out of that mess. And they may go right back into it again.
Yeah. Yep. I mean, this is all by design too, right? And we also see it in credit contraction. I mean, we're already hearing about HELOCs, right? Home equity line of credit, if you're not familiar with that, where they're going up to like 10%. Historically, those things have been like 4 or 5%. And so HELOCs in the past have been used for kind of like piggy banks, ATM machines. That was a problem in the great financial crisis with everybody, and home values skyrocketing and everybody was pulling HELOCs and spending money that way. And but it's a way to, to get a loan loan, short-term loan against the equity in your house for, you can do remodels, whatever. But nobody's tapping into that now because rates are too high. This is all by design. This is the Fed fighting inflation. But I think, and like we saw in yesterday's video with like corrugated cardboard demand has just plummeted. I think, they're getting the Fed induced slowdown. The market's just late to get the memo, I think here, Bob.
No, I totally agree with you. I mean, we could talk about this till we're blue in the face, but I think that money supply is telling us everything. I mean, look, it dwarfs, the rate of change dwarfs anything that's happened in the past. And, it's going to be a problem.
Yeah. So I think we've cycle topped. I think tomorrow we can show them the updated liquidity. We'll see if we get that risk off signal. It's been risk on since mid-May, but we've been looking ahead at a potential turn here. I think we might have got it, and we'll see how that looks tomorrow on the video. So guys, thanks for watching. Bob, welcome back. Thanks for being with us, and we will see you guys on tomorrow's video. Don't forget to hit like and subscribe. Smash that notification bell too if you can, and set the notifications to all. That really helps out the channel, and we'll see you guys tomorrow. Thanks for watching.
Trade Genius.